So, Sony, you acknowledged that the banks have improved since Lehman, but where are the 4 areas of worry?
Well, I think the biggest problem is that we are definitely going to have a shock. I mean, as always happens, be it political through trade war or intrinsic from the financial system. But this time round, we have far less monetary policy space to react. On average, OECD governments have about 30% higher debt to GDP ratio, so much less countercyclical fiscal space. But most of all, international cooperation is sort of much more fragile than it was in 2009 when Gordon Brown called that famous G20 for fiscal stimulus. And the political center today is between 10 to 30 percentage points smaller if you take the center left and the center right, and the fringe is growing. So the political space available to rescue any bank, should one fail, is far, far less today. And I think that means that we are much less prepared for the next financial crash, whatever the source will be.
Yes, and of course, we will try and divine what perhaps might knock us over. Sonny, you also warn on debt. You make a very clear point that our debt load is even heavier now than it was then. $63 trillion of sovereign debt. There's now $63 trillion of outstanding sovereign debt and a total debt of $237 trillion. That's $70 trillion more than we had 10 years ago, or pre-Lehman's. Now, look, debt naturally rises when you discount the cost of money. But are we in a much worse position debt-wise?
Well, I think the sensitivity of the outstanding debt load to any normalization of interest rate means that, yes, many people who look sound, many governments and companies that look sound, when interest rates are 1% or 2%, they will not look so healthy once interest rates normalize. The housing market across the board looks healthier on paper, but it is not very robust against rising interest rates.
Stephen, the fact that we keep talking about the next financial crisis makes me think that, to a certain extent, risk is restrained in a way that it wasn't, of course, in the run-up to 2007. Does that mean that the financial crisis could get put off longer than you might otherwise expect?
The aftermath of the result of the financial crisis is that systemic risk has declined materially. The cause of the crisis and the epicenter was really in the banking sector and around mortgages. And what you've seen is regulatory pronouncements and changes that have taken place. While the risk has not completely disappeared, the systemic risk of a banking crisis has diminished considerably. So I think the real concern isn't about the banking sector so much, but what will be the next causation of the next crisis, which may not be financial in nature. And what is the catalyst for causing that, and what are the mechanisms to deal with such a matter? Because, as noted, there will be another crisis. It's just a matter of severity, the cause, and the aftermath.